my understanding when we talk about yield curve inversion, and please correct me where I'm wrong, is that, if someone came to me and was like, "Hey, can I borrow $100?" I would probably want to know, like, oh, that $100 is valuable to me as cash. So sure, but there's going to be like a premium on that. I'm going to need like some kind of interest on that. So if, normally if I asked you like, well, how long do you want to borrow it for? And you said 10 years, I'd be like, all right, let's say, and pulling this out of my ass, but like, let's say I want a 10% interest on that over the period of 10 years. So I want to make an additional 10%. Normally we would expect that if I asked you that same question and you said 1 year, that I would give you a lower interest rate. I'd say, well, since that $100 is only going to be locked up for 1 year versus 10 years, instead of 10%, I only need 1% interest. And if I understand correctly, yield curve inversion is where we actually see the inverse. So people want to make loans where they are getting the shorter expiration loans are actually higher value. We see higher interest rates on those 1 year, or in this case, I think the common one is a 10 year over the 3 year, right?
10-year and 2 year is the one
10 year
that
and 2 year.
is commonly cited. Yes. And so you have that correct. That's what a positively sloped yield curve is, the natural shape, which is what you were describing in the first part of the example. And an inverted yield curve would be, the opposite of that. Now, what you're describing is a consumer lending type of environment, or even a corporate lending type of environment. But this yield curve inversion that we're talking about is in the US Treasury market, and it's also in other parts of the interest rate derivatives market, um, that is largely based off of the US Treasury market. And the plumbing of the financial system and an inversion there, it's quite different than if we had a consumer facing yield curve inversion, or even a yield conversion a yield curve inversion that would benefit the consumer, someone that borrows at 2 years and has to pay 10% versus someone that only has to pay 2% if they borrowed for 10 years, would be highly advantageous to a consumer. But that's not really what we're talking about here. So you have the example right, but the target market is not, the same thing. And so in the treasury market, the behavior of investors that buy and sell 2 year treasuries has its own entire fundamental dynamic that has to do with the entire world economy, the world's financial system, central banking, asset management, forex management, cash management, all these enormous fields that impact 2 year treasury yields. And then in the 10-year part of the curve as well, we have this entirely, honestly, an enormous universe of actors that play in that market to buy and sell 10-year US treasuries. And some of it being the same as the twos, but some of it being different in that the 10-year part of the US Treasury curve is considered the risk off asset for basically all of asset management. And we can call that probably somewhere between $1 and $300 trillion of size of market for the 10-year part of the curve. So when we look at the difference between 2-year US Treasury yields and 10-year US Treasury yields, we're talking about two parts of the monetary system and financial system that really have their own dynamics. And so to tie it all in, when 2s 10s is inverted, which right now it's essentially flat, it's essentially zero. It's inverted a little bit over the last few months here and there, but we're at a flat level. What the market is saying is that we expect the Fed to be raising rates very quickly, but the overall growth and inflation level of the US economy over a 10-year time horizon is unchanged relative to that increase in short-term interest rates. It's not making it so that the investors believe that, all of this hiking and raising of interest rates is going to turn into long-term inflation, or that long-term inflation is actually something that the market believes. It actually doesn't believe that, and that's expressed with a flat yield curve. The market does not believe that we're headed to 5 to 8% inflation. Otherwise, 10-year yields would be at 5 to 8%. They're not. They're still at 3.25%, just where 2-year yields are. And 2-year yields are at 3.25% because that's where the market believes the Fed is eventually going to hike rates towards. Right now, we're at 1.75%.